Hello again, everyone. It is 9:30 in the morning on Monday, October 31st, 2022. It's Halloween. I'm John Kosar from Asbury Research and Asbury Investment Management, and this is your Daily 5. These are currently my 5 most important charts, data series, and Asbury Research quantitative models that I believe will be the most influential to U.S. stock market direction over the next several weeks and potentially into the early part of next year. So let's begin. Number 1, market internals. The Asbury 6 turned positive on October the 18th. The last time I was with you was October the 18th. And I had mentioned that our Asbury 6 risk management model had effectively been negative since August the 26th. I think the S&P dropped 12% or something into the lows that we made in the early part of October. But on the 18th, I said the Asbury 6 was still negative, but on any further strength, it appeared likely to turn back to positive. It actually did as of the close that day, and it stayed positive. So we are still positive here. Each of these cells, there are 6 cells here that represent 6 different metrics, and only one of them has to do with the price of the S&P 500. It's the rate of change in the S&P 500. The other 5 of these are secondary metrics, let's call them, that can't be influenced by the choppy trading behavior that we have been seeing now, for years. It used to be that we didn't have the S&P up 100 today and down 50 tomorrow and up 70 the next day. I think a lot of that has to do with there's more and more computerized trading during the day. It comprises most of the daily volume. So you get all this volatility, and it's really hard to get a sense of what the market is, what kind of condition the market is just by looking at it day to day with maybe something like volume. So I took my favorite tactical metrics that I've used throughout my career. We started to backtest them in sets of 4, sets of 8, sets of 6, trying to find sort of a team of these indicators where 1 or 2 fail, the other teammate, so to speak, would pick it up and maintain a better signal. So that's what the Asbury 6 is, and we built it to combat this day-to-day volatility that we have. So each of these cells, the date in each of these cells indicates when this particular constituent of the Asbury 6 turned green. So you can see some of these started turning green on October 17th and 18th, and the more recent one was October 28th, which was the end of last week. So here's the chart of that. So you can see on October 18th is when the Asbury 6 went back to positive, and the S&P has risen by 5% since then. 4 or more metrics in one direction, either green, positive, or red for negative, indicate a signal. All 6 are green here, so it's telling me that the market right now is internally very healthy. Number 2, the S&P 500 tactical trend change targets 4025. So here we have the S&P 500 here going back to July of this year. So going back a few months, and a few things we wanted to point out here. For one, when I was with you last on October the 18th, I told you that there's a support level at 3588. 3588 represents the February 2020 benchmark high in the S&P 500. I've been talking about it for months, that this was a really important support level. And we tested it basically 3 times. October 5th, October 13th, we broke it for one day and came roaring back by the close, and then we got kind of close to it October the 21st. The 3 of these lows created an inverse head and shoulders pattern that we broke out of just about a week ago. That pattern targets a move up to 4025. So it also indicates that we have a tangible bottom here at those lows from 3588. The levels that I'm paying a lot of attention to now are, number one, the 50-day moving average. A lot of traders, a lot of investors look at that as a back of the envelope indication of what the minor trend is. So right now, the minor trend has turned up as of Friday. The other important level is the September 6th low. I have it highlighted here in red. That's at 38.77. So 38.77 to 38.42 is now my most important point for this week. And that should turn into a support level if we are indeed going to move higher from here and hit our 40.25 upside target. That would be a minimum upside target, and up above there, the 41.13 area is where the 200-day moving average is. We need to break through there to turn the major trend back to bullish or back to up. Number three, asset flows, money moving back into large cap tech. This chart on top is the NASDAQ 100 going back to April of this year. Down on the bottom is the daily total net assets invested in the Invesco QQQ, which is the ETF that tracks the NDX. From July 6th to August 21st, these assets expanded above their 21-day moving average. Why is 21-day so important? That is our tactical time frame here at Asbury Research. So back above the 21-day from July 6th to August the 21st, that gave us all of this rally. That took us into the mid-August highs. Those assets started to contract, and they moved to a trend of monthly contraction between August 22nd and October 20th. That gave us all of this. That told us it was time to get out of the pool here. As of October the 21st, which is just a little bit more than a week, we are creeping back up above that 21-day moving average. That indicates monthly expansion, and that indicates the NDX, which we need to lead this market higher. If this rally is going to stick, it's starting to get some conviction again. It's starting to get some bullish conviction again. People are buying it, holding it overnight. The other important nuance here is this $148.1 billion area that I'm circling. That was the extreme low in these assets back in the middle of June. We tested it for weeks and held it. I find that these levels are very good support levels for the assets, which leads to a support level in price. So this is really important to me. As long as these assets keep expanding in NDX, this rally is going to have legs and we're going to go higher. Number four, investor sentiment. Two bearish market analysts suggest a strategic bottom. I showed you this chart when I was back here 2 weeks ago, or a variation of this chart. This is the investors' intelligence data. Asbury Research is actually one of the inputs to their data series, which measures how bullish or how bearish. They call a market letter newsletter writers. I don't know if anybody actually writes a physical newsletter anymore, but folks like Asbury Research, independent analysts, some analysts, I guess, who also work for firms, for larger firms, just to see what the pulse of the market is. So have a look at this. On October the 7th, we reached an extreme, least bullish extreme, and this indicator starting to come off of there now. The other previous times on this chart, which goes back to 2010, that the same thing happened was March of 2020. That was the COVID low. January of 2018, that was after that really weak fourth quarter of January 2019, rather, following that really weak quarter that we had Q4 of 2018. Here's March of 2016, September of 2011, and September of 2010. This doesn't tell us when to buy. It isn't tactical, it's more strategic. It tells us what to expect after you buy. And this is telling me that one of these signals that we're going to get from the Asbury 6, which is a tactical tool for us, is going to highlight a bottom in the market that's going to be equivalent in terms of its quality to these bottoms here. So this tells me that not only is the market turning higher from support, we're getting some money flows going back into the NDX, which is really important, or the QQQ rather, but this is a likely place for us to begin a new strategic rally that could last 1 to several quarters. So I try to look at all these different time periods together and come up with kind of a composite of where I think the market is. And right now it looks like the market is forming a important multi-quarter bottom. Number 5, seasonality. Seasonality for me is kind of a tertiary indicator. I don't pay a lot of attention to it unless it fits in with the scenario of everything else we're looking at. Right now it does. Seasonality, November/December, historically means opportunity. So here we have the 13 weeks of the fourth quarter in the S&P 500 based on data that goes all the way back to 1957. What that shows is the final week of October, which was last week, is the weakest week of the entire quarter. And then we have strength. There's some ups and downs in here, but it's generally much stronger once we get to November and December. On an annual basis, also since 57, November and December are the first and third strongest months of the year. So not only do we have all these other good things happening, but we have seasonality also starting to kick in. So there you have it. It looks like there's some opportunity here to maybe put some of that money that hopefully you took out of the market during the first 3 quarters of the year when we were weak, put that back to work here with pretty good risk reward based on leaning on that support level from the October lows and with some other good things happening in various other aspects of the market. So there it is. If you like our approach to markets and investing, I invite you to visit our website at asburyresearch.com to get more information about us. If you'd like to see more videos like this one, you can visit the Asbury Research channel on YouTube and subscribe there. Thanks for watching, and we will see you at the next one.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.